My name is Nick Harris, and I'm here today with a very special guest to talk a little bit about asset management for entrepreneurs. The special guest today is Meg McClellan. Welcome, Meg. I'm glad you're here. Just to give a little bit of background about Meg, she's currently the Managing Director and Head of Private Credit for JPMorgan Global Alternatives. In this role, she's responsible for the strategic direction and oversight of a multi-billion-dollar platform of real estate and corporate private debt strategies. She's also responsible for product development, which involves the strategy, structuring, and execution of new product initiatives. She's also a member of the Global Alternatives Operating Committee. She has served a number of senior roles at JP Morgan, most recently as the CFO for JP Morgan Asset Management. She has led both client and fixed income teams in asset and wealth management. She began her career with JP Morgan as a mortgage-backed securities trader in the investment bank. Her experience prior to JP Morgan includes trading and managing government bonds, derivatives, and securitized products. She holds a BS in mathematics from the University of Chicago, and the MBA is actually from the New York University Stern School of Business. We won't hold that against her. She's also volunteered with shelter dog training programs at the SPCA of Westchester since 2007, and in 2018 received the John W. Beach Memorial Award for contributions to animal welfare. She's also an active member of her high school alma mater, having served on the Phillips Academy Alumni Council as non-civic committee co-chair. You currently reside in Westchester County, New York, with your husband and daughter. Is that correct?
That is correct.
How long have you been in New York?
I've been in New York since, the second time since 2006. The first time was here briefly with my very first job in New York City after growing up in the Southeast.
Awesome. Well, thank you so much for being here with us today. Would you talk a little bit about advancing Black pathways and the commitment that Chase has made to supporting the Black community?
Sure. Advancing Black Pathways was created 3 years ago to strengthen the economic foundation of Black communities and attempt to help close the racial wealth gap. And that's through 4 diversity, equity, and inclusion pillars: business growth and entrepreneurship, financial health and wealth creation, career and skill, and also community development. And we've brought along a great clip today to explain a little bit more about that program.
Awesome. Well, let's take a look at that clip to learn more about the Advancing Black Pathways program.
For far too long, systemic inequities have hindered the Black community's ability to build generational wealth.
Advancing Black Pathways was created to address these systemic challenges and strengthen the economic foundation of Black communities. We're focused on doing this through our 4 impact pillars. By investing in Black-owned businesses, we're creating more jobs and opportunities. We also want to help people improve their financial health and increase access to banking in Black communities. Homeownership is also critical, and we're providing tools, resources, and networks to make the dream a reality. We're committed to creating an ecosystem of support to help Black students and professionals thrive in the workplace.
At JPMorgan Chase, we recognize the responsibility we have to break down structural barriers.
This work can't be done alone. We need a collective action to bring about sustainable change, because we know that when we all get an equal slice of the pie, we all win.
That was terrific. That's awesome. So would you be able to share a little bit more about how Chase is helping Black businesses to grow using this and similar programs?
Yeah, so really this has become ingrained in the fabric and the culture of JPMorgan Chase. And I mentioned those pillars before. Just to give you a couple of live examples, in 2020, we launched Advancing Black Entrepreneurs, which was a free collection of business educational programs and resources. And that's actually available at jpmorganchase.com/ABE for Advancing Black Entrepreneurs. We also made a $30 billion commitment to advance racial equity for Black, Hispanic, and Latino people. And that $30 billion 5-year commitment focuses on addressing some of the biggest drivers of racial wealth gaps. So those are things like homeownership, affordable housing, small business growth, financial health, access to banking, diversity of our own suppliers, and certainly workforce diversity. We've also invested more than $100 million in equity in 14 diverse-owned or minority-led depository institutions and community financial development institutions. So those serve more than 87 communities in 18 states in the District of Columbia. And we've also provided or are providing an additional 15,000 loans to small businesses in majority Black, Hispanic, and Latino communities. And so that will be about $2 billion in lending. And finally, there's the philanthropy and direct equity investments to help Black, Hispanic, Latino, and other underserved small businesses grow. And this includes expanding that Entrepreneurs of Color fund to more U.S. cities. So we're really excited about all of these initiatives to help close some of those gaps, and certainly across all of those 4 pillars that I mentioned earlier. And finally, we have launched a new program, which this group may be interested in, which is meant to help Black, Hispanic, and Latino entrepreneurs access one-on-one coaching and mentorship and technical assistance. This is available whether you're a JPMorgan Chase customer or not. And again, can be found on the JPMorgan Chase website, chase.com/business consultant. That's chase.com/business consultant. So feel free to check that out. And we hope it's valuable to you and would love your feedback.
Awesome, Meg. And so we appreciate the resources. So that was chase.com/business consultant around the new program that you've launched for the coaching and mentorship. And then the URL again for advancing Black entrepreneurs. Correct me if I'm wrong. It was jpmorganchase.com/A as in alpha, B as in beta, E as in echo, ABE for advancing Black entrepreneurs. Is that correct?
Perfect.
Excellent. Excellent. Okay. I'm looking at the chat here. It seems that we have quite a few questions that have come up. So are you ready?
I'm ready.
All right. The first question we have is, in addition to running the global private equity group at JPMorgan Asset Management, you're also a member of the investment committee at Project Spark. Can you tell us a little bit more about that initiative and why you got involved?
Yeah, and it's probably easiest just to start with what sparked Spark, so to speak. In 2020, we met with a woman named Catherine who was just a rock star in private equity. So she had extensive experience in private equity and was leaving her large firm to start a venture capital fund. So we liked her so much, we tried to hire her, but Catherine wasn't interested in coming to work for us, unfortunately. She really wanted to run her own fund. And so we thought, wow, maybe we can invest in her if we can't hire her to work with us. So we thought that would initially be easy, right? We're a $3+ trillion asset and wealth manager within JPMorgan Chase. We have our wealth management teams, which serves individuals, which can invest money, into funds. We also have our asset management business, which chooses third-party funds as part of our investment process. And so we figured there must be pockets of capital seeking, especially diverse-led funds. Well, it turns out there are pockets of that capital seeking those funds, but it's hard to do that as a startup. To give you some examples, this is not unique to JP Morgan, but this is probably fairly standard for the investment industry. If you're trying to become part of a wealth management platform so individuals can invest in your funds, especially large ones, we really need funds that have a minimum of $100 million. So that's a big fund for a startup. You don't tend to see first-time funds with $100 million. And the reason for that is that our investors need to be considerate about their concentration risk in the fund, but also, making sure that they've got the scale and then ultimately the track record to support a really good investment outcome for clients. And on the asset management side, it's a slightly similar story. Again, we're looking for diligence, we're looking for fund track record, we're looking for experience. It's not just investing, also operational due diligence. And that often comes with experience. It's 3 to 5 years really to demonstrate that is replicable and sustainable in these strategies. And so what we recognized there was that something that was supposedly very easy was actually very difficult for a first-time fund founder. And so we looked at that capital gap and said, there's this capital gap between being a startup fund and a scale fund that can actually access the wealth and the asset management dollars because of that diligence process. How do we address that? And the way that we approached it was first the recognition that all these funds need capital, right? So they're investing in startups and entrepreneurs like this group. And so we would like to give them capital to do that. Second is making sure that they have access to our network. So we have extensive experience running funds and diligencing funds. So we can help with everything from marketing pitch to, those operational due diligence questions I referenced, to, what we look for in track records, how we view competitive landscapes. So really share some insight as to what, kind of large scale managers are looking for when they make investments. In addition to leveraging our extensive network of legal and operational experts. And then third was really the brand. We felt like having a JPMorgan commitment to these funds could help them attract other investors. Right, so the brand could give credibility because we're well known in the asset management, wealth management space as a very strong asset manager. So we thought those three things could help bridge that gap: the money, the network of experts, and then hopefully our brand.
Excellent. So the money, the network, and the brand. I like the framework there. So I have a follow-up question. You talked a little bit about that there is some demand for pockets of investment here, whether it's on the asset management or the wealth management side. So I often hear that the excuse that there's a lack of investment for diverse managers and entrepreneurs is because there's no pipeline. Has this actually been your experience on the supply side or demand side, I should say? And how has Spark built a pipeline?
Yeah, so I both love and somewhat despise when I hear that, because our experience once we launched Spark was we've had over 200 diverse fund managers referred to us just through word of mouth. So we did one press release for Spark, and the next thing we know, like our LinkedIn's are blowing up with referrals, which was great. We're getting things through the JPMorgan Chase network, through our Chase partners, through our investment bank, through our asset and wealth management network, personal networks, professional networks, things coming in from people I haven't spoken to since high school. It's just been great. And I think what was so exciting about it was it addresses a question of where are the diverse fund founders? Well, the answer is they're here, but there's that issue of that gap, that capital gap I mentioned earlier, to get to the scale, size that they need in order to be onboarded into some of these major investment houses. So to that point, don't let anyone ever tell you they're not diverse fund managers out there, because that's just wrong. But then when you're thinking about a project like Spark that's seeking to spark the change to being scale managers, you really have to be intentional about what you're looking for. And so we specifically set a goal of underrepresented investors. These are founders of funds who are women and people of color, LGBTQ+. And we're specifically targeting our capital towards those founders, recognizing there's such a need for capital in this space. And then really the third key is around making space. It's easy to have like a really tight funnel of how you assess people and managers. And we certainly do have that. It's really important as a fiduciary in asset management and wealth management that we have a very defined, very replicable, documented set of reasons that we would onboard and invest money in a fund. So what we had to do was make space to invest in new funds that maybe didn't meet those investment criteria. And so that commitment of capital that, certainly has an investment committee process and diligence around it, but, maybe we didn't have to have a 3 or 5 year track record. Maybe, with these strategies, we could help the founder actually create the proper governance around it to be successful, which is not something we would do with an established manager. So, that making space, is really, really important if you want to spark change. And I would actually say that as someone who entered this industry without the right pedigree. I didn't come into Wall Street with the requisite, 2 or 3 summers of internships. I have a math degree. I waitressed and taught math. But I really wanted to do this. And I had a manager in a firm take a shot on me, with no prior experience, because they were trying to make space for underrepresented people. And, female with a math degree, they said, well, she doesn't really have the exact right experience, but they made that space for me. And I'm incredibly grateful. And so it continues to resonate with me that we need to do that for others that may be similarly underrepresented.
Wow, thanks, Meg. That's a great story. And I appreciate you sharing that with our audience here. I think it means a lot that not only do we have these programs that are in place, but people like yourself who actually have been through situations where you were given a shot, roadblocks were removed so that you could be successful. And now you're paying that forward by removing roadblocks yourself. So let me ask you this. What are the major roadblocks or additional roadblocks for diverse founders and funders when it really comes to raising capital?
So I love this question, and we've learned so much through Spark. Most of the investments, just for context, that we make are typically in mature investments or mature industries. So being part of the fund managers' journeys with venture investing has really been eye-opening for us. So when people ask what the roadblock is, you're typically going to hear someone say it's a lack of capital, but to me, it's not like this just lack of capital is where the answer ends. It's what causes a lack of capital. And how I've come to understand it is that the people who hold the power and the purse strings don't necessarily understand the opportunity set. So even if some of these fund founders and some of the entrepreneurs they're investing in get in front of I'm going to put right in quotes, audience, that audience may not understand or be comfortable with what they're pitching or understand the market set. I'd say one of the things about Spark that's interesting is 4 of our 5 investment committee members are women. And so we probably actually have a bias towards things like women's healthcare. And that is a $5 trillion market opportunity. But we heard, certainly one of our funds that we've invested in called Steel Sky, when they're going to fundraise and, we hear stories of some of the companies they've invested in, some of the conversations make people squeamish. They're talking about innovations and femtech to address, menstrual cycle irregularity and, think about improving women's wellness exams. And so that's not necessarily a comfortable topic to address with every audience. And so often it's not necessarily understood. And so that is one example of where you may have a great idea and a great business and a great market and something highly differentiated, but the capital and the purse strings don't follow that because it's not particularly well understood. So we were really excited to invest with Steel Sky as people who understand this from firsthand experience. And we've heard similar stories with everything from Black hair care products to a revolutionary new device that delivers collagen and other types of microdroplets into your skin. But again, these are topics that it feels like if you have some firsthand understanding of them, it's easier to identify. So, having this network is really important. And I think having more diverse people controlling the purse strings and the power is also very, very important.
No, that's fantastic. So a lot of barriers there, and it looks like you have identified some of those and you're actually lowering those barriers and helping those roadblocks to be removed. So we appreciate your work there. So that's a little bit about the foundation and infrastructure of Spark. So where's Spark today? Can you give us an update?
Yeah, so we started this, and just to be frank, this was a little bit of entrepreneurship on our part, right? Like we didn't know if people, especially fund founders, would be interested in working with us, and so we initially put a $25 million commitment out. That was gone very quickly with some of the great founders like the ones that I've mentioned. And then we had another 25 million that was invested by our investment bank. So it's 50 million total that has been committed by our firm across 16 different emerging funds. Of those investments, we've had almost 20 million of capital called, and that's funding something like 90 underlying portfolio companies. And in terms of the construction of the portfolio, because I think this would be interesting for this group, we've got 27% of our managers are Black. 20% are Hispanic, 12% are Asian, 14% have identified as LGBTQ+, and about 65% of our managers are female. So the other metric that we consider is whether funds are single, double, or triple impact. And what that means is a single impact fund is a diverse fund founder. A double impact fund is a diverse female fund founder, which is investing in diverse or female entrepreneurs. And a triple impact is when you've got a diverse founder, a diverse set of entrepreneurs, and they're addressing diverse needs of a community. So I'd put Steel Sky that I mentioned earlier in that category. Diverse founders, really diverse groups that they're investing with, and it's women's healthcare. So that's single, double, and triple impact. Right now, we've got about 56% are double impact and 26% are triple impact in terms of the fund founders we're working with.
Wow, that's terrific. So how will you know that Project Spark is ultimately successful?
So the broad definition of how this is successful is whether or not this sparks the change we want to see in the asset management industry. So, do we have, to your question on pipeline earlier, not just a pipeline of 200 plus at the early stage, but do we have that same pipeline, a much more robust pipeline for funds that are 100 million plus that can make it onto these larger platforms and create their own asset managers. So, the first place that you have to look to get bigger and better is ultimately your performance. So we're looking for investment performance out of these funds. We're looking at whether or not they're tackling a large addressable market with their products. Do they have a differentiated investment or sourcing approach that will help their performance and the investment stand out from the crowd? A lot of that is their experience. Again, they haven't necessarily run funds before, so we're looking at their actual operating or entrepreneurship experience. What about, how they're sourcing the opportunities? Is there some, sort of incubator that they're working with that has some unique aspect to it that seems to produce interesting results? And then also, what are the barriers to entry about what they're doing? So it is incredibly difficult to get, patents and FDA approval and things like that. And people who spend, years of their lives researching, ultimately launching these products have probably got a higher barrier to entry to competitors, than other types of companies. So we do diversify across all kinds of industries, but we're always looking for something that will help differentiate performance, a differentiated process, and ultimately, looking for things that will make this type of an approach very successful. And then I think the other piece that we look for in terms of success is how to use our brand to support these managers. So when we raise future capital, or when they go out to raise future capital, we are going to introduce them into our network, again, internally, to those mentioned earlier, the wealth management and the asset management channels, so that when they do get to that scale size and can support large client investments, it can support a robust long-term due diligence process, they have hopefully a warm introduction from us. And certainly we will introduce them into other asset management networks. And we've been doing that. So kind of the opposite of what you typically expect is us to be competitive. In this case, we want these entrepreneurs and these fund managers to succeed. And so we've been excited to find that there are other companies doing something similar to Spark and, form some referrals with them, which is great.
I like it. So the brand, the network, and also all the things that you guys are doing to provide the support to make sure that entrepreneurs and fund managers are successful at every step along the way. I love that. So let me ask you this, last question in this topic. I have some more questions that are coming through the Q&A in the chat. But what must entrepreneurs understand about raising funds? And what have you learned over the years? Are there any tips that you might give?
Yeah, so I think one of the things we've seen in our selection process is the fund founders that have experience themselves or have some unique knowledge of how startups work, how, what kind of legal challenges you might have, what's the best way to set up your operations, how should your supply chain work, how do you think about talent sourcing, all of these things, that operating experience or operating expertise that can actually help your business is part of what we look for, right? Like, what is the fund manager adding to the companies that it's investing in other than the capital? Because we really, support fund founders who are active and constructive in terms of how that company is going to move forward. So I'd suggest to this audience, it's really important to find true partners who have good operating experience. Anyone, I don't mean to say this to be offensive, but anyone can put together a great PowerPoint deck of ideas, but actually operating and getting them executed is a completely, different skill set. And so to me, we're looking for people that get their hands dirty or have gotten their hands dirty or understand what it means to get your hands dirty to really buckle down and help these companies be successful. And then I think the other big piece of advice to this group is do not be afraid to ask. Like, I'm here because I care deeply about this topic and we're excited to be part of Kinetic. But we'd love for people to reach out over LinkedIn, right? So we're happy to open up our networks and help people succeed. So just don't be afraid to ask. We had a fund that we invest in called Supply Change. They saw that JPMorgan was hosting an event at South by Southwest, and they were looking for an invite. And we think they're fantastic. We were very happy to invite them to that event. So, again, please do not be afraid to ask. I think a number of us are trying everything we can to advance this need in asset management and in venture capital, and we're all here to help. So, please just take us up on that.
Excellent. Okay, thank you. So a couple of more questions have come in. First one here is, who's on the investment committee for Project Spark? And what value do you think the group brings to the process and managers?
So we've got 5 investment committee members, voting investment committee members, myself. So I'm in alternative investments and private credit. So we make loans to, real estate and corporations and infrastructure. Our second member and our chair is Jamie Kramer. So she runs our JPMorgan Alternatives platform. So it's a third party strategy. So she actually diligences managers. So she's an expert at diligence. She spent a lot of her career doing that. And so she runs an investment team that commits capital. So she's got great expertise in fund selection. Lee Spellman, who's head of our U.S. equity business. So she runs a massive U.S. equity platform. So she is an expert at, company and company valuation, small, mid, large cap. So she really understands earnings life cycles, how companies should work. And Lisa Coleman, who leads our investment grade credit investment in public markets. So she understands credit and financing inside out. And then finally, Brandon Robinson. So Brandon joined JPMorgan a couple of years ago. He's got previous experience in alternative asset management. He is a CFO by background. And he is absolutely just phenomenally thoughtful around some of the diligencing questions, how we think about the fund structure and setup, and he's absolutely passionate about the topic the way that we all are. So I think what's interesting about us is we're 100% female and person of color investment committee, which you don't see a lot of and yet. And I think, I mentioned earlier that some of the advantages of that are that we may see needs in, our networks and our communities that maybe aren't broadly understood by, potentially more homogenous types of investment committees.
Sounds like a very experienced group. That's excellent. So what have you learned since launching Project Spark almost a year ago?
So I think number one was, you always have this theory that there are great diverse managers out there, but you're not quite sure how to find and support them. So this has taught us that, again, being intentional and creating space is the way to, we hope, close this gap and spark a change in the future. And so that was a big lesson for me, because I think for years, a number of us have said, well, how do we do this? And, friends would refer female entrepreneurs who are looking for funding round. And, it was a little bit, I'd say, too organic. And I think having a real mission here with some structure around it, and certainly the JPMorgan name behind it, I feel like that's been a big learning for me, is that we can, do well and do good. And this is a great example of that. And I think the other thing that I've learned is just, this is really exciting. The founders that we've talked to and the companies that they're working with, the ingenuity and the creativity and just the drive of, the entrepreneurs in every community that we're exposed to it is stunning. I don't have any other word for it. It is exciting. It is absolutely fulfilling and just life affirming to see the creativity and this drive in what everyone's doing. And again, we're looking at all kinds of different companies through the lens of these founders. And it makes me excited to be part of this really dynamic economy that's full of these amazing entrepreneurs.
Now, that's really good to hear. So on the other side of that, what would you tell emerging managers? What would they need to know before they, try to seek funds from Project Spark?
So if you're an emerging fund manager, really, I think that differentiation for what you're doing is important. I think some of the places where we've seen people struggle, and we certainly can't accept 100% of everyone who pitches to us, is where they've got such a broad investment criteria. It's unclear whether or not they're focused enough or have enough sort of differentiation, right? So it's like the jack of all trades, master of none. So the themes you'd see in our investments so far have really been some sort of a target or focus, whether that's, consumer brands, or I mentioned women's healthcare or ag and food tech. And so that to us, I think is a real differentiator, with people have focus and they have vision and they have specific expertise in an area that can be valuable to the fund's performance.
Okay. And what advice do you have or have you received that might serve entrepreneurs raising funds to make their dreams ultimately come true?
I mean, there's no substitute for elbow grease, right? This is hard work. It is extraordinary. I think the passion and drive that put people in the position that they want to raise capital for this amazing idea or thing that they're doing. But it is just pounding the pavement, getting out there, and again, work that network. Reach out to your second and third connections. Have friends introduce you to other friends. I mean, I've been really excited about introducing some of the Spark investments to friends of mine in my network that don't work at JPMorgan, simply because they're active in venture, or they're active in other spaces that may be beneficial to these founders and their companies. So, again, I think that pounding the pavement, no substitute, but when you do that, make sure you take people's contact information, reach out, and follow up.
All right. Pound the pavement, elbow grease, making sure you leverage your network and follow up. Great advice, great takeaways. Well, Meg, I want to thank you again for being here, and a big thanks to all that you're doing in JPMorgan to support the Black community. Thank you.
Thank you. I appreciate it.